Good morning. This is Horizon's Middle East and Africa. Our top stories this morning.
The state of Qatar, the Arab Republic of Egypt, and the United States of America are pleased to announce the success of joint mediation efforts, resulting in an agreement between the parties to the conflict in the Gaza Strip.
The ceasefire between Israel and Hamas will begin on Sunday and last for 6 weeks. The deal includes the release of 33 hostages, while Israel will withdraw from parts of Gaza and free hundreds of Palestinian prisoners. And risk on. Cooler CPI fires up Fed rate cut bets and sparks a global rally with Asian stocks tracking Wall Street gains. Well, it's just gone 8 a.m. across the Emirates. I'm Jumana Bersachi in Dubai. A historic moment. We are going to be spending a lot of the time on this show talking about the deal that has been agreed to between Israel and Hamas, as announced by Qatar and U.S. yesterday. A major milestone. What does it mean for the future of Gaza and the future of Arab relations in the region? All of these questions we will be posing throughout the course of the show. But as ever, let's just kick off the show with a look back at markets, because we had quite the rally yesterday. Remember, we were all anticipating the CPI print into the event. Markets were trading a little bit sideways, some nervousness. It was going to be a pivotal print, and a pivotal print it was. The core CPI numbers surprised slightly, just slightly to the downside. But what that meant is we got a massive and outsized market reaction, with the S&P seeing its best day since the November elections, up 1.8% yesterday. The Nasdaq also ending the session up 2.5%, 2.45% higher on the session as well. So very strong day for Magnificent Seven, as the market was quick to start pricing out, or pricing in, I should say, further interest rate cuts. Yields, huge rally, 10-year yields 4.65. We rallied about 14 basis points after that number came out. I should also say on the equity space, it wasn't all about the CPI print. We had very strong banks earnings come through as well. The financial sector really led some of the rally that we saw in the S&P. And today we get further earnings on the slate as well. Dollar yen in focus this morning. As you can see, the yen continues to gain ground versus the USD. Today about 0.5% firmer on reports coming out, local media suggesting that the Bank of Japan will indeed go ahead for that interest rate hike next week. And certainly there have been, once again, expectations building into that event, and that is providing some support to the yen here. So we're sitting at around a 155 handle, down about 200 pips over the course of this week. Let's turn to some of the local markets, though. Many of these markets are actually still closed for trading. But let me just run through some of the price action that we've had more broadly. Brent, take a look at Brent actually this morning, trading at $82. There hasn't been a lot of geopolitical premium priced in to the oil complex. You would think that a ceasefire announcement would push down the energy complex. That hasn't been the case, because what the market is focusing on here is a drawdown in stockpiles in the U.S. In addition to these possibility of further sanctions and the Biden administration sanctions that were applied to Russia a week ago. So that's been driving the energy complex. Tadawul, Saudi Arabia, you can see today, are leaning towards the green. Over the course of the last couple of weeks, we have been rallying. The Tel Aviv Stock Exchange, interesting one, not open for trading yet, but up about 26% since the end of the summer. On the ceasefire deal with Lebanon, and of course into anticipation of the ceasefire deal with Gaza. So we've seen a massive run-up in the Tel Aviv index into today's event. And then the shekel also trading firmly versus the USD. We are at the highs of the year versus the dollar today, about 0.6% firmer. So that's it for local markets and how they're reacting to the news. But let's do a bit of political analysis here. Israel and Hamas have agreed to a ceasefire deal in Gaza, pausing 15 months of fighting that has killed thousands of people and destroyed much of the territory. The three-phased agreement will take effect on Sunday and will initially see the release of 33 hostages held in Gaza and Israel's withdrawal from populated areas in the Strip.
The first phase of the agreement, lasting 42 days, will involve a ceasefire and the withdrawal of Israeli forces to the east, away from the densely populated areas, to positions along the borders in all areas of the Gaza Strip. It will also include the exchange of prisoners and hostages according to a specific mechanism, the exchange of the remains of the deceased, and the return of displaced persons to their homes.
During the next 6 weeks, Israel will negotiate the necessary arrangements to get phase 2, which is a permanent end of the war. Let me say it again, a permanent end of the war. There are a number of details to negotiate to move from phase 1 to phase 2, but the plan says if negotiations take longer than 6 weeks, the ceasefire will continue.
Stuart Livingston-Wallace is Bloomberg's executive editor for Middle East, North Africa and Russia. Just listening to the comments there from President Biden, talking about the challenges, really, of moving away from phase 1, which is being dubbed the humanitarian phase, the exchange of hostages for these Palestinian prisoners, the passageway of humanitarian aid, a temporary ceasefire. But he says that there's still a lot of challenges remaining in order for us to move to a permanent ceasefire. What are some of the obstacles in the way?
I mean, it's a mountain of challenges. So starting with the most basic things is they've got to identify where all the hostages are and then agree which ones to release in what order. On the Israeli side, in that first phase, which Palestinian prisoners to release. And remember, the lesson for Israel here is Sinwar, who's the guy who masterminded the start of this whole war, was exactly one of those people. You know, he was a prisoner that was released in a hostage deal. So there's going to be awareness there. I think then domestic pressure on both sides. You know, this is a deal basically that was on the table 6 months ago, and Hamas rejected it. So there is dissension in those ranks. And on the Israeli side, as you know, there is a significant portion of the government that is adamantly opposed to any sort of deal. So going forward, those are the initial problems, and then you've got to rebuild this enclave. And, you know, I don't think anyone's put a credible number yet on how much that will cost, how long it will take. We've seen horrific estimates that it might take a decade just to clear the rubble. So there's a long, long way to go.
Possibly even more by some estimates. Stuart, talk us through the Israeli internal politics. The government will be voting on the deal today. They still haven't officially passed it or signed off on it. Is there a chance that it doesn't go through?
I think most people are expecting it to go through, and the reason being the following, that Bibi has managed to extend his coalition over the last few weeks, and that gives him a little bit of breathing space. So even if Ben Gvir, for instance, refuses to back it, which does seem quite likely, that won't be enough to derail it. And I think the finance minister is hanging on there. It looks like he'll probably stay in the government with a view to what might happen under the Trump administration with regard to the West Bank, which you know, largely meets his longer-term objectives. So even though he doesn't necessarily like this deal, he might go along with it. Yeah,
well, we heard from the Qatari PM. He gave a press conference yesterday. Qatar played a major role in getting this deal across the line, one of the key negotiators. President Biden as well gave comments. And then, of course, President-elect Donald Trump was quick to take to social media, posted a lot about the deal and how excited he was about the deal, but then also claiming credit for it as well. Do you think it matters for the longevity of this deal that the Trump team feels some ownership towards it?
Yeah, absolutely, because it's going to keep pressing. And I think you saw his, you know, his envoy Witkoff as really one of the key players here. You know, he by all accounts, didn't hold back in his communications with Israel, you know, calling them on the Sabbath and all that sort of thing. So, yes, that definitely was a factor. So I think they deserve a little bit of the credit there, for sure. I don't know how you portion it out quite in a fair way. But, yes, going forward for the next 4 years, there is definitely a line in the sand here about what Trump intends to do. And again, rather like the finance minister in Israel, he has a long-term view about what he would like to do in terms of redrawing what the Middle East looks like, getting some sort of extension to the Abraham Accords. That is ultimately the prize here.
Well, a big achievement to start with in his first day in office, the inauguration on Monday. Stuart Livingston-Wallace, Bloomberg's executive editor for Middle East, North Africa and Russia. Let's continue the conversation. Ryan Bohl, senior Middle East and North Africa analyst at RANE, joins us. Good to have you with us, Ryan, on this important day. Do you see this as the first steps towards a permanent end to this war, or are we just talking about a temporary cessation of hostilities?
I think what we're looking for is a transition to a new kind of conflict, and it will resemble some of the pre-October 7th world in some ways, and it will be a new world in others. It's important to note that Hamas's traditional deterrence to Israel, its vast rocket arsenal, has been exhausted and decimated, and it will not be able to quickly rebuild that. And without that deterrence, Israel can act unilaterally in the Gaza Strip against Hamas through airstrikes, drone strikes, commando raids, to continue to try to degrade the group even past the 6-week deadline. And once Hamas and Palestinian Islamic Jihad and the others have given up their hostages, they'll no longer have any political leverage over the Israelis to prevent such operations.
What do you think happens to Hamas from this point onwards? They obviously do not have international legitimacy. Phase 3 of the ceasefire deal talks about the reconstruction efforts of Gaza, what future governance looks like. None of the international community wants Hamas to play a role in future governance. But at the same time, many of Hamas operatives still exist and they're around, and they're apparently, reportedly, still being able to recruit new people to join into their ranks. So what happens to them now?
Well, certainly Hamas must adapt. Now, how it adapts is going to be up to the agency of Hamas's own groups, its own internal factions, its remaining leadership. But they have a few broad choices. The first is to adapt to life inside of Gaza, where there's still a resistance movement. They're essentially an insurgency, and that as Israel continues to apply military pressure over time, they fight that battle in Gaza itself and hope that eventually Israel's resolve to carry out such a campaign eventually withers and breaks down and allows Hamas to resume power in the Gaza Strip. The other option they've got is, of course, to go into exile, which is what the Israelis very much want them to do. I don't see that as terribly likely at this moment, but it's something that could happen in the medium term if Israel's military pressure continues to be sustained. And then the final is that Hamas essentially does a factionalization of its organization. So instead of a Hamas as a united organization across many countries, you have Hamas in Gaza acting one way, Hamas in Qatar acting another way, Hamas in Lebanon acting a different way, and these factions then make it so that Hamas is more of an umbrella organization rather than a coherent, single-minded entity.
Yeah. Yeah. Ryan, I want to take you back to a conversation we had around the time of the beginning of the Israeli incursion into Lebanon. And I don't know if you remember this, but at the time you did say and suggest that it was another potential 1967 moment for Israel at the beginning of a multifaceted conflict in the region. Now you fast forward a couple of months later, and in retrospect, do you think this has been similar to 1967 in the sense that Israel has managed to weaken their so-called enemies in the region and to come out of this victoriously?
On the military front, I do tend to think that comparison is going to remain relatively accurate. Let's look at the scene of the region. Assad is gone, and no one saw that coming 12 weeks ago, or 12 months ago, even 12 weeks ago. The Hezbollah has been decimated, Hassan Nasrallah assassinated, Iran has been attacked not once but twice, including at its sensitive nuclear site, and there's possibilities of further attacks. Israel is now operating in Yemen. So from a military standpoint, Israel has achieved significant gains against its adversaries and reduced their deterrence. Iran's ballistic missiles simply aren't as scary as they were, say, 2 years ago. Hezbollah certainly seems to have not been quite a paper tiger. They're certainly very dangerous, but they didn't carry out the large-scale destruction that the Israelis expected. But there's now this real open question as to whether or not they can win this sort of cold peace that they'll be entering. And that's where the comparison to 1967 may also still be apt, because after 67, Israel didn't win that peace. It got stuck in a war of attrition and had to fight a second war in 1973. That is a possibility, particularly in places like the West Bank, where Israel could be facing another security crisis in the near future.
Yeah. How does the return of Trump and the Trump administration now change the calculus in the Middle East? And of course, he is claiming some credit. You probably heard me speaking to Stuart about that before you came on, and that the Middle East envoy, Steve Witkoff, did actually play quite an active role in getting this deal across the line. But what does the return of Trump actually mean to the dynamics in this region?
Well, on the one hand, it does change some of the threat perceptions. There's a belief that Trump will escalate very quickly in response to provocations. That will make countries like Iran and, of course, Hezbollah reticent to go back to fighting Israel out of concern of that very fast escalation. But Trump is also not an unknown quantity. He escalates very quickly, but he de-escalates very quickly. We can remember the Iran crisis of 2020 after Qasem Soleimani was assassinated. Trump was very eager to get off that escalation ladder. He doesn't want to fight long wars. And so that calculation will also factor in how the remnants of the axis of resistance decide to behave going forward. Now, if Hamas decides to carry out an insurgency against Israel in the Gaza Strip, they will calculate that the Americans won't have an appetite for a long war.
Ryan, thank you so much for coming on our show today. We appreciate your time. Ryan Bohl, Senior Middle East and North Africa Analyst at RANE. Thank you. Well, still ahead, U.S. and Asian stocks notching gains as a cooler U.S. CPI reading fuels bets for Fed rate cuts this year. Algorithm Research shares their market strategy next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Versace in Dubai. Shares in Asia follow Wall Street higher after easing U.S. core inflation keeps the prospect of Fed rate cuts this year still alive. And markets were certainly quick to start pricing in more rate cuts. Let's bring in Ketaki Sharma, founder and CEO of Algorithm Research. It's great to have you with us on the show. Lots of people had been, watching out for this CPI print yesterday. And we got quite an outsized market reaction on what was a very tiny miss. Do you think this disinflationary trend is going to continue in the U.S.?
Firstly, thanks so much for having me here. I would say that this is maybe something that we would watch out for. We would call it more of a blip unless there is a clear trend. And for us to call it a trend, we'll have to have such prints for a couple of months to call it a trend. So for now, I think it's a great reading to have, but we can't really call it a disinflationary trend as yet.
Where could the upside surprises to inflation come from in coming months?
So there are many avenues. So the much promised tariff tax is definitely one of those, and the large scale deportation that has been talked about extensively could be another source of wage inflation. So there are serious upside risks to CPI inflation at the moment, and therefore I think there's a lot more to worry about.
But it's almost like the anticipation of policy. You can't, if you're the Fed, if you're sitting in the Fed right now, you can't actually change your interest rate direction of travel based on what you think the Trump administration may do. So they're in a bit of a tricky situation because there's all of these talks about extra tariffs, deportations. It will probably take a couple of months and maybe even a year in the case of tariffs to figure out the actual impact that it's going to have on inflation. How do you think all of those factors are going to impact the Fed's thinking?
I mean, that's great. I mean, exactly the point. It might take a year, but the rhetoric is so strong that it feeds into inflationary expectations. And as you know, inflationary expectations feed into future inflation. So I think there is a lot, even if it's staggered, even if it's delayed, news flow, rhetoric, those are important things to watch.
To your point on inflation expectations, yesterday on the show we showed a chart of 10-year break-evens, inflation break-evens, which suggests that the market's expectation of inflation, where it's going to average over the next 10 years, keeps going up. So you've got to think that's going to be a bit problematic for the Fed.
Absolutely.
And will keep them away from cutting too deeply.
Absolutely.
But the market is already there. What about growth? How do you see the growth outlook this year in the U.S.?
So for now, the growth is on fire. The labor market is doing great. It's robust. So, and if there's the much promised deportation, you'll see wage inflation for sure. So I would not be too worried about growth, at least in the U.S., but certainly about inflation. So that is something to really watch out for.
Yeah, lots of people have been commenting on the shape of the U.S. yield curve. The steepening that has taken place, but also the expectation that perhaps longer-term yields may continue to stay elevated because of certain structural factors and also because of concerns about the term premium derived from the fiscal outlook in the U.S.
Right.
Do you think some of those points are actually valid and that these higher yields, at least in the long end, are with us to stay?
Oh, yes. I think the higher yields and in the long end are here to stay. But I won't be too concerned about it. Like, for me, the immediate thing is to anchor inflation. And that is something that can be controlled through, to some extent, news flow and the kind of news you put out. And certainly it doesn't help. The social media chatter doesn't really help.
No, it doesn't help anyone.
No.
Social media chatter is terrible for everybody. The USD, the dollar, is trading at a 2-year high. Do you expect that to continue to be highly correlated with where interest rates are trading?
Yes.
So what we've seen is yields sell off, the dollar has strengthened. Is that correlation going to continue in the foreseeable future?
Yes, for sure. Yes.
Why?
Yes. I mean, there's a strong correlation anyway. So a stronger dollar would mean also for our, for our region, import inflation, right? It helps keep import inflation in check. So a stronger dollar is great for the region. Also,
for this region.
For this region, for sure. Yeah, because we import in dollars.
Yeah. Final question for you. Lots of people have been talking about U.S. exceptionalism and that the U.S. is going to be the relative bright spots amongst the world's major economies this year. Do you have that view as well?
Yes, I do have that view. I think the U.S. is in a great position right now with great growth, great job market. It's just inflation that needs to be tackled. So basically, the Fed has only one problem to solve. If you look at the other economies, say in Europe, in UK, they have problem of stagflation to some extent. There is stagnant growth, but high inflation. So there's a dual issue to solve.
Yeah, I remember Jean-Claude Trichet used to say, we've got one needle in our compass, and that's the needle that we're talking about, U.S. inflation problem. It's a real pleasure to chat to you. Thank you so much for coming on the show. Ketaki Sharma, founder and CEO of Algorithm Research. Well, stay with us. Plenty more coming up on the show. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Versace in Dubai. President Biden has delivered his farewell address from the Oval Office, listing his achievements over the past 4 years, while also voicing concern about the future of the U.S. The president said he is worried about the consequences if wealthy Americans use their influence to win tax breaks or roll back efforts to combat climate change.
I want to warn the country of some things that give me great concern. This is a dangerous concentration, and that's a dangerous concentration of power in the hands of a very few ultra-wealthy people. And the dangerous consequences if their abuse of power is left unchecked. Today, an oligarchy is taking shape in America of extreme wealth, power, and influence that literally threatens our entire democracy, our basic rights and freedoms.
Any guesses for who President Biden may be referring to there? Okay, let's take a look at how equity markets are faring up. We had the CPI print come in yesterday, slightly lower than expectations. That led to a major rally in Wall Street. S&P saw its best day since the elections. Today, not doing a whole lot, but we are going to be keeping an eye out for further U.S. bank earnings coming on later in the session. Coming up, a ceasefire deal has been reached between Israel and Hamas in Gaza. We speak to Carla Slim from Standard Chartered on how it will lower geopolitical risks. Good morning. This is Horizons Middle East and Africa. Our top stories this morning.
The state of Qatar, the Arab Republic of Egypt, and the United States of America are pleased to announce the success of joint mediation efforts, resulting in an agreement between the parties to the conflict in the Gaza Strip.
The ceasefire between Israel and Hamas will begin on Sunday and last for 6 weeks. The deal includes the release of 33 hostages, while Israel will withdraw from parts of Gaza and free hundreds of Palestinian prisoners. And risk on. Cooler CPI fires up Fed rate cut bets and sparks a global rally with Asian stocks tracking Wall Street gains. Well, it's just on 8:30 a.m. across the Emirates. I'm Jumana Versace in Dubai. A big day for the region. We're going to talk more about the implications of the ceasefire and what it may mean for geopolitical risk over here in a short while. But for now, let's just take a quick look at how markets are faring, because we had a monster rally on Wall Street yesterday. The S&P seeing its best day since November, since the elections, up almost 2% on the day. Nasdaq up more than 2.5% on the day, bolstered by that lower than expected CPI print, rate cut expectations once again building back into the U.S. curve, but also very strong bank earnings coming through yesterday. JP Morgan, Citi, Wells Fargo, all posting very solid results. Today, we're going to be watching out for results from Morgan Stanley and Bank of America. So that's also on slate later today. But 10-year yields, massive rally yesterday. We rallied about 15 basis points after that CPI print, sitting at 4.65% now. And then the dollar losing a little bit of ground versus the yen. Not often that this year I've been talking about the dollar losing ground, but here we are today. This on expectations that the Bank of Japan may actually go for that interest rate hike next week. And there have been reports, the Nikkei newspaper in Japan, suggesting that a rate hike is on the table. So that's giving some strength to the yen. Flipping over, I do want to just show you some of the more local market boards as well. Many of these indices still closed for trading, but just to highlight, Brent, which is open for trading, obviously, is trading at around $82. A bit of an uptick there on a reduced stockpile inventory in the U.S. and again reacting to the news of the new sanctions that the Biden administration is going to be imposing on Russia producers, tankers. So we're still seeing that being embedded into the energy complex. The Saudi Arabian Tadawul index has been gaining the last couple of weeks, but the real story, one of the strongest local stories, has been on the Tel Aviv index. It's up about 25% since the end of the summer, into and out of the Israel-Hezbollah ceasefire and into expectations of the Israel-Gaza ceasefire, which we're seeing this morning. So that's the Tel Aviv index, and then the Israeli shekel trading at the highs of the year versus the USD, or the tights of the year, I should say, rather, the strongest levels versus the USD, today about 0.6% stronger versus the dollar. Now, on to the main story. Israel and Hamas have agreed to a ceasefire deal in Gaza, pausing 15 months of fighting that has killed thousands of people and destroyed much of the territory. The agreement will take effect on Sunday and promises the release of 33 hostages held in Gaza and hundreds of Palestinians detained in Israeli prisons. The halt in fighting should also allow desperately needed humanitarian aid into the Strip. Joining us now is Carla Slim, MENA Economist at Standard Chartered. Carla, good to have you with us. To begin with, let me just start from an economist perspective. Was there a lot of geopolitical risk premium baked into the region, to begin with, anyway, before we talk about what happens next?
Good morning, Jomana, and great to be back on the show, especially on such an upbeat note with all of the positive developments that we've had. We've had a lot of geopolitical risk in the region for the last 15 months, not so much risk premium baked into either oil prices or into any market indicators that we've seen over the last 12 months. But still, the fact that geopolitical risk is now abating and we have these positive developments, and coupled with the fact that oil prices are higher, although we have less geopolitical risk premium, that should bode quite well and is making for a positive start for the year.
So you said there hasn't been a lot of geopolitical risk premium, but I do wonder whether sentiment has been hit. And sentiment is often a strong driver of things like FDI into the region. If these ceasefires, and here I'm not only talking about Israel-Hamas, but also Israel-Hezbollah, manage to move away from temporary ceasefires to permanent ceasefires, what does that do to investor sentiment, you think?
You're absolutely right about sentiment. And where we were also seeing sentiment being suppressed was in oil prices because of this narrative of below than envisaged China oil demand growth on oil prices. That was weighing on oil prices. So sentiment has shifted completely, whether it's on oil prices or on the geopolitical risk outlook for the region. And as you mentioned, the key concern or the key characteristic now will be whether this temporary rise in oil prices and temporary improvement in the geopolitical risk can be sustained for the rest of the year. We do believe so.
Yeah, I was going to ask you, since we are talking about oil, do you think we stay around these levels then, $80?
Yes, our oil price forecast, our in-house projection for the year is just over $85. And this is baking in the fundamentals, the fact that we do see global oil demand growth of over 1 million barrels per day in 2025. And as we've seen, supply has been constrained, whether by OPEC or now the newly imposed Russian.
I thought it was interesting that IEA yesterday actually slightly revised upwards their forecast for demand. Let's turn to Lebanon and talk about what happens there next. Now the government formation process begins. How influential is this future government going to be in terms of how it impacts where Lebanon financial assets are trading? Obviously, there's been a massive run-up in Eurobonds into this, recent nominations.
So the Eurobond rally started in Q4 last year on the rebalancing of power, taking this forward-looking view that things could move quickly. And things have moved quickly, but perhaps even faster than what the Eurobonds were implying, and that's why we're seeing the rally being sustained, which is quite remarkable. Now the risk which could slow down is the government formation process, specifically since the Prime Minister has already used his influence, and the President as well, to change the parameters for the government formation process. So the ministerial allocations will slightly break from the past process, and every 5 MPs will be able to nominate one minister, and it's a reduced cabinet. That reduced cabinet can be very influential in terms of a financial rescue plan and a restructuring for Eurobonds, but they only have a year because the next parliamentary elections are in 2026.
Of course, so that's something that's it's a ticking. There's a clock ticking, yes, essentially. It's interesting that there's been a bit of a divergence between what's been happening in bonds in Lebanon, the Eurobonds and FX, where there hasn't been that much of a reaction, or at least not as much of an outsized reaction as what we've seen in Eurobonds. Why is that the case?
Correct. So there's been little to no reaction on dollar LBP, whether on the parallel market or the interbank market, which serves to reconfirm the fact that the central bank has been managing FX volatility quite closely with a view of inflation targeting and bringing down inflation, because Lebanon did have hyperinflation for 3 years. So essentially that we will likely also see monetary policy reform on the back of these positive changes in the future as well.
Sort of to bring it back to the geopolitics, we know, and we've been talking about this on the show, that Saudi Arabia, other Gulf states have been playing an increasingly active role in this new Middle East, or the developments that have happened in the last couple of months, a lot of shuttling of diplomacy. Do you think that Gulf FDI and Gulf money and Gulf tourism could be a big driver for growth going forwards?
Absolutely. And what we wrote in the note that we released just this week was that the new president hasn't been in office for a week yet, and already relations have started to improve, and FDI announcements have already started coming through. So we do think this is likely, but perhaps also the other element to watch out for is tourism revenue. So if and when the travel bans are lifted, the GCC travel bans are lifted, we could potentially see a doubling of tourism, foreign tourist arrivals into Lebanon to their historical highs, which could drive tourism revenue up by $5 billion.
That's good news. I've got to say, personally, though, it's not good news for the airport because the queues will be terrible. Just to round things up on perhaps a more somber note, the reconstruction efforts are also huge. The World Bank losses were something north of $6 billion. You probably know the figure better than me. Is that going to be Lebanon itself that will have to go down the route of reconstruction, or do you expect international assistance, Gulf assistance to come through with the reconstruction plan?
That's going to be a key consideration also for the bond and banking sector restructuring, because if the government does decide to go through on budget for the $8.5 billion reconstruction, then that's going to mean a very wide fiscal deficit, and then that will matter for the recovery values of the Eurobonds. So we believe that external funding will likely play a larger role than government funding in that reconstruction.
So interesting. Carla, great to have you on. Thank you for your perspectives. Carla Slim, MENA Economist at Standard Chartered. Thank you. Now, for a look at some of the other stories we're following, Hindenburg Research founder Nate Anderson says he is shutting down his short-selling firm, famous for targeting billionaires Gautam Adani, Jack Dorsey, and Carl Icahn. In a post on the firm's website, Anderson says there's no specific threat, health, or personal issue behind the decision. He says he now views Hindenburg as a chapter in his life, not the central thing that defines him. Bloomberg has learned that Citadel, the hedge fund manager founded by Ken Griffin, has sold $1 billion of high-grade bonds to fund a payout to its owners. Citadel has sold bonds before, including in 2017 and 2019, to fund dividend payments. The Miami-based firm recorded a roughly 15% gain in its flagship strategy last year. And Bloomberg has learned that Canada has drawn up a list of $105 billion worth of American goods that it would hit with tariffs if President-elect Donald Trump imposes levies on its northerly neighbor. Our source says the list will only come into play if Trump moves first and may be expanded later, depending on what the U.S. does. So Canada firing some shots there. All right, coming up, on the cusp of a Trump-led administration, Middle East policy could see a shift to Israel-Gulf relations. We'll discuss the details next. This is Bloomberg.
next week. Live from the Alpine Mountains of Switzerland, it's the World Economic Forum annual meeting in Davos. Bloomberg Television brings you unmatched coverage and conversations with world leaders, business executives, and billionaires as they navigate the AI age, energy transition, and geopolitical tensions. Tune in for daily coverage all next week, only on Bloomberg. Context changes everything.
Welcome back to Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai. Israel and Hamas have agreed to a ceasefire deal, which is set to start on Sunday, just one day ahead of Donald Trump's inauguration. As the new administration prepares to enter the White House, Middle East policy could shift to Israel-Gulf relations and expanding the Abraham Accords, focusing on Saudi Arabia as the next major partner. So lots of things to discuss. Let's bring in Avi Hasson, CEO of Startup Nation Central, who is in Tel Aviv. Good to have you with us on this quite monumental day. Let me just start off by asking you, yesterday we had a guest on the show who was the CEO of one of the largest VC funds in Israel. And I'm going to ask you the same question I asked her, and that is, what do you think the implementation of this ceasefire deal could mean for businesses, for sentiment, and for the macroeconomic outlook?
Good morning, Jumana. It's good to be back here. Let me just say it's a morning of hope, and it's a very optimistic morning here in the Middle East. Obviously, after 15 months of conflict, hopefully we're in a trajectory to bring back the hostages and make this ceasefire a permanent one. With regard to your question, actually we just came out with our 2024 report, and it was quite remarkable to see that even though Israel and the region had to cope with this ongoing war, the amount of investment in Israeli high-tech companies, the level of mergers and acquisition deals was quite remarkable, showing the resilience and really the strength of the sector. So that was when the war was taking place and happening, and carrying its toll, of course, from reserve duty service to the international travel disruption. I think looking in the future, if indeed we are towards a de-escalation, we can expect not just going back to those levels, but actually increasing the mutual collaboration and economic activity. So I'm quite optimistic.
Can I just ask you if whether the Abraham Accords actually did lead to a pickup in trade with the countries who signed it, between Israel and the UAE, Israel and Morocco, Israel and Bahrain? Did you actually see a pickup in trade?
Yeah, so before October 7th, obviously, we've already had almost 3 years of the Accords. And when we look into different indicators, bilateral trade is an example. The bilateral trade between the UAE and Israel, taking one example, reached over $3 billion on an annual volume, which is quite significant, by the way. That makes the UAE one of the top trade partners for Israel. And that was a reflection of ongoing activity that really went across sector. At Startup Nation Central, we mostly deal with the competitiveness and health of the innovation ecosystem and have been involved in multiple initiatives within the region. We've seen a lot of collaboration between businesses. We've seen investment coming over from the Gulf to Israeli tech companies, and we've seen Israeli companies co-locating in Dubai, in Morocco, and to some extent also in Bahrain. So I think the first 3 years taught us that the potential is huge, and also taught us that these agreements can go beyond just government-to-government, G2G agreement, and really includes wider parts of the economy and the society, really reflecting what the region can do together, not just to solve its own problems, but also to create global leadership and address global customers.
Well, the big prize would be a normalization of relations with Saudi Arabia. Of course, many, many political hurdles to get to until we get to that point. But how much potential do you think that would unlock for the region and for businesses that operate within Israel if that were to come to fruition?
So, as you say exactly, that holds the greatest potential. And it's true both on the bilateral level. We're talking about different economies, right? The Saudi economy is 40% based on natural resources, mostly oil. The Israeli economy is actually 20% of its GDP is based on tech. That's twice the share of the US, 3 times more than the EU. But as these two economies can combine forces, there's a lot of potential. From helping to implement and realize MBS Vision 2030 programs, with some of the mega projects where Israel, with its innovation capabilities, can be of service, but also of working together, combining the capabilities of the two countries and really solving some of the region challenges and problems, from the reconstruction that was mentioned to looking into issues of food and water security, health-related issues, and also cybersecurity and defense. So that's a great potential. But if you go a little bit broader, I think what we have today, especially given what we're seeing in the Middle East, is the possibility to create a new Middle East, which is really combined of countries that have mind share which is similar, that looks into the future and can want to create an economic corridor, starting all the way from India to Europe. The possibilities there are great, and if we dare to imagine, we can see the power of innovation and economy really creating a region that becomes an economic powerhouse, not just for its own sake, but also in terms of the global leadership.
Yeah, and that is the hope, of course, for the region to live in peace and stability. Avi Hasson, thank you so much for coming on our show today. As Startup Nation Central CEO, thank you very much. Well, coming up, Mozambique's new president sworn in amid ongoing protests, economic woes, and disputed election results. All the latest on the inauguration next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai. Daniel Chapo has been sworn in as Mozambique's new president, taking over a nation shattered by months of protests that have claimed hundreds of lives and crippled the economy. Bloomberg's Matthew Hill joins us from Johannesburg. Matt, good to have you with us. Well, we know that the country has witnessed several months of protests now. Chapo is indeed quite the contentious choice. How big of a job does he face?
Hi, Jumana. Thanks very much. The task facing Daniel Chapo is immense, and you can really break it down into two main parts. The first being the political crisis. As you mentioned, the country has been racked by months of unrest. An opposition leader named Venancio Mondlane rejected the October election outcome as fraudulent and has been orchestrating protests ever since. So it'll be crucial for Daniel Chapo to establish a dialogue with Venancio Mondlane and other key political players to reach some kind of deal or compromise to end that political standoff. The other major challenge is the economy. Even before the elections, Mozambique was already one of the poorest countries in the world, and the unrest has only amplified the problems that the economy faces by cutting growth. For example, Standard Bank Group sees the economy shrinking in the last quarter of last year, and again in this current quarter, which is going to be a big hit on government finances.
Yeah. Matt, can he actually get on with the job of governing, given that the opposition rejected the election results? I mean, you talk about the challenges facing the economy, but are we in for more political instability?
Well, Venancio Mondlane, the opposition leader, has said that he does not plan to end the protests and that they should continue. So it will be very, very important for Daniel Chapo to establish a meaningful dialogue with Mondlane and others to reach some kind of compromise that will bring an end to the protests and then start getting the economy back on track. We are also going to be watching out for key ministerial positions from Daniel Chapo, especially the Minister of Finance, who's going to face an incredibly complex task in restoring investor confidence, where many businesses have seen their warehouses and factories looted and burned during the unrest. And also, Mozambique is home to some of the world's biggest natural gas reserves. And companies like Total Energies and ExxonMobil have been planning massive projects, some of Africa's biggest private investments, which have been on hold for years now. So a lot of investors will be watching if Chapo will finally be able to get those off the ground again.
Interesting. Thank you for giving us that extra perspective. I didn't know that about Mozambique and natural gas. Bloomberg's Matthew Hill, thanks so much. Now for a look at some of the other stories we're following. Nigeria's annual inflation rate climbed close to a 29-year high in December before an overhaul of the data later this month that may lower the gauge. Consumer prices rose just shy of 35% in the year to December. Transportation costs were the main drivers of the price increases, and food inflation slowed slightly to just under 40% year on year. The WHO says the deadly Marburg virus is suspected to have infected as many as 9 people, including 8 fatally in Tanzania's Kagera region. From the same family as the Ebola virus, Marburg was first recognized in 1967, but a fatal case was only identified in 2021. And Gabon's military leader has picked a new economy minister to resolve the Central African oil producers' debt woes. Mark Dumba, an entrepreneur who studied public administration at Harvard, takes over at the key ministry after a cabinet reshuffle. The shakeup comes days after the World Bank suspended disbursements to Gabon over debt arrears. And a look at equity futures as we head to the break. Markets not doing a whole lot, a bit of a hangover after yesterday's rally. We had a very strong rally for Wall Street. S&P futures ending the day, S&P 500 ending the day up 1.8%, NASDAQ up 2.5%. But coming up in our next hour, we are going to be talking more about the CPI print. Todd Elmer from InTouch Capital Markets, Deutsche Bank's Danelee Masia, plus IHG Hotels comes up. Good morning. This is Horizon's Middle East and Africa. Our top stories this morning.
The state of Qatar, the Arab Republic of Egypt, and the United States of America are pleased to announce the success of joint mediation efforts, resulting in an agreement between the parties to the conflict in the Gaza Strip.
The ceasefire between Israel and Hamas will begin on Sunday and last for 6 weeks. The deal includes the release of 33 hostages, while Israel will withdraw from parts of Gaza and free hundreds of Palestinian prisoners. And risk on. Cooler CPI fires up Fed rate cuts and rate cut bets and sparks a global rally with Asian stocks tracking Wall Street gains. Good morning, everybody. It's just gone 9 a.m. across the Emirates. I'm Jumana Bersachi in Dubai.
And I'm Jennifer Zabasaja in Johannesburg, where it's just gone at past 7 a.m. Welcome to the second hour of Horizon's Middle East and Africa. And Jumana, a number of news and also eco-related threads that we're following this morning.
Yeah, absolutely, Jennifer. The big news of the day, of course, the fact that Israel and Hamas have agreed to a ceasefire deal. We're going to be speaking to Dan Williams in Jerusalem shortly to go over the details of that deal. But yesterday was a big day for markets as well. So let's just recap some of the price action that we had. The CPI number came in slightly, marginally lower than expectations. That core number month on month came in a miss versus what the market had penciled in. And on the back of that, we had a massively outsized reaction. Wall Street very solid in the green. The S&P up more than 1.8%. Its best day since November, so since the elections, but also aided by some of the strong bank earnings that came through yesterday as well. So that gave a bit of a boost. Also, Tesla had a good day yesterday. NASDAQ, also very strong day, up more than 2.5%. So really very strong price action in equities. At rates, we saw a very strong rally. So 10-year yields down 15 basis points after that CPI print came through. The market once again quick to start pricing in more rate cuts out of the Fed this year. And then the dollar in focus as well. But this morning, we're paying close attention to what's been happening to the yen because once again, rate hike expectations are building up into next week on back of some media reports suggesting that the Bank of Japan are readying themselves for a hike. So that's giving some support to the yen. As for some of the local markets, we're taking a look at them today to see how things have been faring in the run-up to the ceasefire announcement. Brent trading at $82. So as we've talked about on the show, there has not been a lot of geopolitical risk priced into oil. There's been more of a focus on some of the fundamentals and the fact that the Biden administration, one of their parting shots, has decided to apply sanctions to Russia. So ever since then, Brent has been steadily climbing higher, so up around 7% over the course of the week. Tadawul, Saudi Arabia also putting in a good run. Tel Aviv Stock Exchange up around 25% since the end of the summer last year, so into and expecting a ceasefire deal to be announced. So a lot of that positivity being reflected in some of the stocks traded on the Tel Aviv Stock Exchange. And then the Israeli shekel as well strengthening versus the USD. We are at the highest level, or the strongest level versus the USD for the year today, 0.6% stronger. But on to the political details. Israel and Hamas have agreed to a ceasefire deal in Gaza, pausing 15 months of fighting that has killed thousands of people and destroyed much of the territory. The three-phase agreement will take effect on Sunday and will initially see the release of 33 hostages held in Gaza and Israel's withdrawal from populated areas in the Strip.
The first phase of the agreement, lasting 42 days, will involve a ceasefire and the withdrawal of Israeli forces to the east, away from the densely populated areas, to positions along the borders in all areas of the Gaza Strip. It will also include the exchange of prisoners and hostages according to a specific mechanism, the exchange of the remains of the deceased, and the return of displaced persons to their homes.
During the next 6 weeks, Israel will negotiate the necessary arrangements to get phase 2, which is a permanent end of the war. Let me say it again, a permanent end of the war. There are a number of details to negotiate to move from phase 1 to phase 2, but the plan says if negotiations take longer than 6 weeks, the ceasefire will continue.
Let's get out to Jerusalem now and speak to Bloomberg's Dan Williams. So putting together all of the details that we've heard about the ceasefire deal, it seems pretty evident, Dan, that the first phase of the deal involves the humanitarian phase, so to speak, the exchange of hostages for prisoners, the release of extra humanitarian assistance into the Gaza Strip. But the big question is how we transition from phase 1 to phase 2, which would imply a more long-term ceasefire and cessation of hostilities.
That's an excellent observation, Jumana. The only deal in place right now is that phase 1 deal. When we discuss phase 2 and phase 3, those are on paper, those are aspirational, but as President Biden said, those still need to be negotiated over. So really those aren't in hand. And in a sense, we may see that this phase 1 proves open-ended, with only 1/3 of the hostages having been released, with a fraction of the Palestinian prisoners that Hamas wants to be released being released, and an ongoing presence of the Israeli military in the Gaza Strip, with all the friction that will arise from that. The big problem here, the rub in moving from phase 1 to phase 2 and 3, is not just what happens with the remaining 2/3 of the hostages for Israel, it's whether Israel will formally relent on its binding, government-approved war goal of seeing Hamas completely destroyed, or at least dismantled, as the governing and military force in the Gaza Strip. I'm not sure Hamas will allow that, will submit to that, unless in the course of that, for future negotiation, Hamas agrees to some sort of power share, voluntarily relinquishing power in the Gaza Strip.
And talk us through how this is being met with back home. Clearly, a lot of elation, many people very happy to see the return of hostages. But there were some within the Israeli government who were against Netanyahu agreeing to this ceasefire deal. Is there any way that the deal could be scuppered when they vote on it later today?
Well, I think reactions will crescendo today when we're expecting Netanyahu to assemble the inner security cabinet and the wider cabinet to vote on this deal. And then traditionally, Israel gives a grace period before implementation to allow the relatives of people killed or wounded by Palestinian prisoners slated for relief, to allow those relatives to submit court motions. So tensions will run high. There will be expressions of opposition, especially, as you noted, from right-wing camps in Israel. This was a very destructive war for Israel. It was certainly destructive in Gaza, but it's worth keeping in mind that the number of Israeli soldiers lost in this war per capita is about 4 times that lost by the United States in Afghanistan and in Iraq over a much longer period. So many Israelis will be wondering if it was worth it if they don't get all the hostages back and if the war goals aren't achieved. There will be relief at the return of hostages. Some of them are expected to come back as soon as Sunday. There will also be some grief because we know, we anticipate that some of those hostages will prove to have died in captivity. Their families will not know that for sure until they see their loved ones coming back in coffins. So that will be definitely a mixed reaction publicly in Israel, which will affect the tenor of the discussion down the line.
The number of Israeli soldiers lost, that ratio that you highlighted, is very noteworthy, Dan. Is there a perception that Israel has come out of this victorious? Has the 15-month war been a success from the Israeli perspective?
I think it depends what lens you put on it. If you swivel the lens and zoom in very close to Gaza alone, if Hamas remains in power, and we will certainly be seeing Hamas victory parades. We already saw one, a small popular show of elation you showed in the video insert. But certainly Israelis will not see that as a victory, given that they were promised the end of Hamas in the Gaza Strip. If you zoom out a bit, this was a regional war in which Israel really shifted the balance entirely all the way to Iran. Hezbollah has been really gutted in Lebanon. That contributed to the fall of the Assad regime. This is a 50-year enemy of Israel. In Syria, Iraqi militias have pretty much stopped firing. Really, the only active firing on Israel has been from the Houthis in Yemen. And while they've done this with technical virtuosity, the distance and the capabilities of Israeli air defenses have really prevented that from causing great damage within Israel. And then there's a big question of Iran. Israel has yet to have a showdown with Iran, but it did manage, I think, to humiliate Iran with 2 rounds of fighting in which Israel says it destroyed, for now, the missile-making capabilities of the Iranians and their air defenses, basically leaving them very vulnerable should the question of the Iranian nuclear program come to a head under the Trump administration.
Yeah. Bloomberg's Dan Williams in Jerusalem. Thank you so much for the reporting today.
Now let's turn to what's happening in the markets. Shares in Asia follow Wall Street higher after easing U.S. core inflation keeps alive the prospect of Fed rate cuts this year. Joining us is Todd Elmer, head of FX and macro analysis for Asia at In Touch Capital Markets. Todd, great to get you on this show, especially on such a busy day. So, one of the descriptions that we're hearing about the markets and the reaction to CPI is exuberance. Has this print all but mitigated any of the concerns that inflation was picking up for you?
Honestly, it hasn't really changed my view. I think what we've seen in the market over the past several days is a bit of overshooting in both directions, where the market probably went too far in terms of taking out rate cut expectations in the wake of the stronger payrolls. And now the CPI has provided a bit of relief and we've swung back the other direction. But where that ultimately leaves us is with a Fed that's going to be patient for the foreseeable future, particularly as there is a great deal of uncertainty looming over the actual policies that we will see under the new Trump administration and as to how that is going to play out over time for the economy. So what we're hearing from the Fed is that they're in a good spot. They have scope to be patient. And I think that's probably what the data ultimately reinforces today. There is some stickiness in inflation, but we just aren't seeing a great deal of demand-driven inflation at this point.
What does that mean, Todd, then, for your outlook for cuts this year? Is your assessment still that we will potentially only see one?
I think that it's been a difficult period to be an investor, and certainly I don't envy the forecasters in having to shift views recently. But I think where we've settled is probably, not unreasonable expectation that the first further move that we're going to see from the Fed is probably going to happen sometime midsummer, and then the market has priced in most of the likelihood that we see an additional cut. That's what the Fed has been saying, and I see no reason to, have a major shift in that outlook at this point.
Todd, how does that impact the USD? The dollar is trading at a 2-year high, I just wonder whether it's going to lose some steam because the market once again has started to price in more rate cuts out of the Fed this year. There's about 38 basis points priced in now. A few days ago, it was less than 25. In addition to what could be the beginning of a further disinflationary trend, both of those things could be negative for the USD.
I think you're absolutely right to point out that the rise in yields has been a critical factor in terms of driving the dollar higher. But I think we have to kind of decompose some of the reasons as to why yields have been moving higher. Part of that does come down to this expectation that the inflationary backdrop was less favorable and it was going to give the Fed less scope to ease. But that's not the only factor that has been pushing yields higher. We've seen rises in term premium. We've seen the expectation that Trump policies may add to inflationary pressures. And we've seen increased focus on U.S. fiscal stance. And I think that a lot of those other factors that have supported yields broadly, in addition to these inflationary concerns, those aren't going to go away even if we did see a faster decline in the outright pace of inflation. And I think that that probably limits scope for a pullback, particularly at the back end when we look at the moves in yields. And I think that that probably is going to lend a degree of support for the dollar. I admit that that isn't necessarily as positive for the dollar as expectation for stronger growth and continued U.S. exceptionalism would be. But when we look at the alternatives to the dollar, there just aren't many that look more attractive at this point.
Yeah. Thoughts on dollar yen? Yen has been rallying the last couple of days. Expectations that the Bank of Japan will hike next week. What do you see happening with the currency?
It's another one where I don't envy traders, the back and forth that we've seen over the last several weeks as expectations have kind of swung both ways on the Bank of Japan. And I think that we are starting to see the types of indications in the media that we might expect if the BOJ were on the cusp of moving. And so the market has firmed up those expectations. But I think ultimately the question there is down to global factors. How will Trump policies impact broad moves in terms of the dollar and therefore pass through to the yen, even if Japan isn't necessarily the focus at this point of Trump's trade policy or what we expect to be the main focal point. But then also ultimately, will we see the dynamism in the domestic economy that is likely to contribute to more tightening over the entire course of the year, over the entire course of the cycle than investors are now anticipating. I think that latter, I think both of those questions are kind of unanswered at this point. And I think that leaves the yen in a bit of a holding pattern, even as the BOJ starts to take further tentative steps.
We have to leave it there. Todd Elmer, head of FX and macro analysis for Asia at InTouch Capital Markets. Staying up late for us, Todd. Appreciate your insights and for joining us this morning. Now, still ahead, a closer look at earnings for the big U.S. banks as they close out the Biden era with a surge in profits. The details on that next. This is Bloomberg. Four of the biggest banks in the U.S. have ended the Biden era on a high note, notching their second most profitable year on record. Bloomberg finance correspondent Harry Brumpton is joining us now. So, Harry, get us up to speed on what we did see from these initial earnings. What are some of the common themes that you're picking out?
Yeah, surprising and very solid set of results across the street from the big four that we've seen so far. I think Goldman Sachs had the record trading revenues. JP Morgan notched the record profit for any US bank in history. Citibank was three out of its 5 divisions made record revenues, and Wells Fargo saw its investment banking revenues jump a whole 62%. So some pretty positive stuff across the board, and that really does meet the expectations that analysts had going into this. There was a lot of bullishness around not only these results and the lack of seasonality that's really been helped and pushed by the tailwind of the election, which means a lot of volatility, people hedging, that helps those kind of trading businesses that a lot of the firms have, as well as a strong economy that's kind of, we've seen a pretty solid run of deal making, including M&A on the advisory side as well. So solid stuff that met and exceeded expectations across the board. The next question, I guess, is going to be how long does it last? How long does it go for? saw, as I say, this was a seasonal element. We saw the same thing happen in the first year of the Biden administration. But then there are idiosyncratic elements to a renewed Trump administration that people are kind of baking in, particularly around financial services and banks as it relates to stress tests, the levels that they have to hold capital, deregulation agenda, and all sorts of other things that people are kind of expecting going forward in terms of capital allocation from the banks as well.
Certainly, and we heard a bit of that from Jamie Dimon speaking after these earnings were released. What does that mean then for the rest of the year? Can you explain a little bit more about what he told us?
Yeah, so I think there's been some interesting lines about them, dancing in the streets about the results and also the potential economic agenda of a second Trump administration that would last time we saw and there's expectations around tax cuts, around bank deregulation, as well as just what he might do for the economy and keep GDP growth going quite strongly with a business-first agenda that would obviously help banks. I think there's some caveats to that as well. We'll see how long that lasts. I mean, a big part of the big investment banks and Wall Street banks' revenues still depend on advisory fees like IPOs in equity capital markets, which are wholly dependent on confidence, as well as mergers and acquisitions as well, which is very much dependent on corporate confidence. And if we see any sort of international ructions, geopolitical brinksmanship that we've seen in prior Trump comments and the prior administration dating to 2016, then those things could present a problem down the track as well. But as it stands, the banks have been promising revenue growth, possible capital buybacks as well to goose the share price, as well as an increase in trading and investment banking activities.
Yeah, and positive closes for some of the big banks on Wednesday. Bloomberg's finance correspondent Harry Brumpton joining us. Harry, thanks so much for your insights. Now, coming up, Mozambique's new president sworn in amid protests, economic woes, and disputed election results. We take a look at the challenges ahead. That's next. This is Bloomberg.
Chapo has been sworn in as Mozambique's new president, taking over a nation shattered by months of protests that have claimed hundreds of lives and crippled the economy. Bloomberg's Matthew Hill joins us from Cape Town. Matt, so talk to us about how big a job Daniel Chapo is going to be facing, a clearly very contentious last couple of months.
The new president's job is immense, and you can really break it down into two parts. The first being the political crisis, where an opposition leader, Venancio Mondlane, has been orchestrating months of protests since the October elections that he rejected as fraudulent, and he's indicated that there are no plans to stop those. So it'll be crucial for Daniel Chapo to reach out to the opposition, including Venancio Mondlane, and reach some kind of political understanding or compromise that can bring an end to the unrest and get the economy back on track. And that's the second big challenge that he faces, the economy. Mozambique was already one of the poorest countries even before the elections, with many young people who face limited opportunities and are growing increasingly frustrated about that. So it will be crucial for him to reestablish growth in the economy too.
So what should we be watching out for next? Is it political developments or developments in the economy?
Yeah, I guess both are going to be crucial and are very much interrelated. I mean, firstly, investors are very eager to see Chapo reaching some kind of political settlement that can allow everyone to get on with their jobs and rebuilding the economy. And also, people are going to be watching out for key appointments. Chapo has said that he plans on actually cutting down the size of government, which will generate annual savings of about $266 million. But also crucial to Mozambique is natural gas projects that Total Energies and ExxonMobil have up in the north of the country. Those have been on hold for years and promise to transform the economy. So everyone will be watching very closely whether Chapo will finally be able to get those off the ground.
Yeah. Yeah, Bloomberg's Matthew Hill, thank you so much for giving us an overview of the latest from Mozambique. Well, coming up, Nigeria's annual inflation nears a 29-year high in December. We will be unpacking the data next with analysis on Nigeria and other countries around Africa as well. This is Bloomberg.
This is Horizons Middle East and Africa, our top stories this morning.
The state of Qatar, the Arab Republic of Egypt, and the United States of America are pleased to announce the success of joint mediation efforts, resulting in an agreement between the parties to the conflict in the Gaza Strip.
The ceasefire between Israel and Hamas will begin on Sunday and last for 6 weeks. The deal includes the release of 33 hostages, while Israel will withdraw from parts of Gaza and free hundreds of Palestinian prisoners. And risk on, cooler CPI fires up Fed rate cut bets and sparks a global rally with Asian stocks tracking Wall Street gains. It has just gone 7:30 a.m. in South Africa. I'm Jennifer Zabasaja in Johannesburg.
And I'm Jumana Bersachi in Dubai, where it's just gone 9:30 a.m. Welcome to the second hour of Horizons Middle East and Africa. Really big news day over here in the region, Jennifer, with the news of the ceasefire agreement finally being reached between Israel and Hamas. So a moment that many over here in the region had been waiting for, the conflict going on for more than 14 months.
Yeah, I heard somebody saying over 400 days. So certainly welcome news for many people. And listen, also a big news for markets in terms of eco data that we were getting. We mentioned that U.S. CPI print. So let's just take a look at where markets are positioned just now, digesting a lot of these threads. We mentioned that U.S. CPI showing that potentially disinflation is more entrenched than expected. If we take a look at U.S. futures, though, little change right now, but that comes after a sharp reaction to that CPI print on Wednesday. We did see all of the major indices in the U.S. closing in the green. We saw the S&P seeing its best close since November, erasing its year-to-date losses, as well as the NASDAQ jumping over 2% and wiping year-to-date losses. Right now, the U.S. 10-year yield unchanged, but again, reaction to that print, seeing drops across the board for yields right now. The 10-year hovering at 4.65% after 8 straight days of yield increases. The yen is also in focus. We got some news from the BOJ potentially hinting at a possible rate hike in January, provided not too many negative surprises from the incoming Trump administration in just a few days. But right now, we're seeing 156.03, and Brent crude still in focus as a number of news lines are paying attention to what is happening with oil. Nonetheless, obviously the ceasefire, but Brent crude right now just above $82 a barrel. And the CPI print leading to swaps traders back to fully pricing in a Fed rate cut by July, as this terminal chart is showing, now weighing potentially 1 to 2 cuts this year. And potentially we continue to see more risk appetite being tested. But again, a lot is contingent on what we do see from the Trump administration in just a few days. Jumana?
Well, Jennifer, we've got some breaking news coming through. Earnings results for TSMC, the world's largest fab. So it is a beat. Fourth quarter net income coming in at $374 billion thereabouts versus estimates of 369 Taiwanese dollars. Gross margin also coming in at 59% versus 58.5% expectations. So once again, a beat. And it's pretty impressive. Our colleagues on the Markets Live team saying that it is keeping up with its impressive streak of outperforming average estimates. One thing to bear in mind, of course, is the geopolitical considerations that Jen and I were talking about yesterday, and that the Biden administration is considering extra curbs on some of the chip exports to China. About 12% of TSMC's chips are actually directed towards China, so there could be somewhat of an impact there if the curbs do get followed on through by TSMC. But overall, the results are pretty positive. Another beat.
Yeah, that's right. Now, let's turn back to the region here. Nigeria's annual inflation rate climbed to a near 29-year high in December before an overhaul of the data later this month that may lower the gauge. For more, let's bring in Danelee Masia. She is Deutsche Bank's chief economist for South Africa and Sub-Saharan Africa, joining me here in studio, which I'm very pleased to say. Danelee, thanks for joining us. So I wanted to start here with this record that we did get for inflation in Nigeria. President Tinubu has pledged 15% inflation by the end of the year. Given this print, is that realistic?
Thanks, Jennifer. I looked at that and I thought to myself, well, you know, if we do not have a substantial rally in the Naira, it's going to be very hard to get a 15% year-end level, and especially because we're looking at such structural drivers behind inflation. So you almost would need to have a 5% month-on-month drop in January to get you to a 15% year-end level. And so we would probably pin year-end levels at about 24%, substantially higher.
Which brings me to this rebasing of the data. Talk us through how that could potentially get Nigeria down to a lower inflation print.
Yes, these changes typically have substantial effects, and especially for countries that do not update their CPI as frequently as, for example, South Africa does. My understanding of this is that the base year currently is sitting at about 2010, and it would be adjusted to 2024. So it's a 14-year build-up in what statisticians call these biases that can sometimes overinflate the actual inflation. And so typically now that the price level gets reset, and it gets reset at such a high base level, you may actually find that we get a January outcome that might be substantially lower than what we would have ordinarily forecast. So, you know, my thinking here is that you also have to think about, besides resetting the base, you've got to look at the new weights that would be coming in. And I don't think there's a substantial shift in the impact that the weights would make themselves. There's a couple of question marks as to why they specifically chose these weight levels. But to give you a sense, they've taken food down from 50 to 40. It's still really big, but then they've supplanted that difference in the restaurants category, which have moved up, and these two kind of are correlated. They co-move. So I don't think the weights make a big difference. But the base effect from the reset in the base can potentially drop as much as 5 percentage points down, depending how they're going to link the old and the new index. And that could take you well below 30% then for the January print, or as much as. But I think, you know, typically these kind of effects then peter out, and then by year end we might still sit with a fairly high level. So I wouldn't put it at substantially below 20% at year end at this point.
And you also mentioned the Naira. Before we get to South Africa, can you talk about, we got this print from the U.S. on CPI, how much hinges on what we do see with the Trump administration, with the dollar, and again with what the Fed ultimately is doing for Nigeria and the Naira?
And it's going to be a tricky one, right? I think Nigeria at this point in time is attempting really to tap global markets again. They've raised their dollar reserves, but they are still highly vulnerable to the world price dynamic. Luckily, the current environment actually helps them a little bit. But whether they are going to go abroad to bolster their revenues by issuing another sovereign loan, for example, that could be quite costly. And typically a base effect change in even your GDP could make you look like you've got better fiscal space, but quite frankly, now's not the time to go and extend further debt, in my opinion. So I think, you know, Nigeria needs to play it really carefully. All said and done, we're actually quite bullish on the Naira, and we think that the Naira can stabilize at 1.5, so 1,500, but potentially even stronger if, you know, these kind of dominoes fall into place.
And we'll see whether or not that actually happens. Danelee, let's move to South Africa. You and your team had an out-of-consensus call on what we would see from the SARB in 2025. Where are you at right now? Do you still stand by that outlook?
We think that the Reserve Bank can cut once more to 750, and that's kind of the terminal rate that we then would expect to last right into next year. So it partly hinges on the Deutsche Bank house view that the Fed would not be cutting at all well into 2026. Even though the Fed has moved by 100 basis points, the Reserve Bank has taken a real structural view around inflation risks, and it monitors global debt problems, it monitors global risk, premiums in the bond curves, and South Africa is a price taker in that regard. And all of these, with very weak structural reform in South Africa, can translate into more pressure for us, the rand, and then inflation. And so we think one more cut hinges on the fact that our inflation is low. Growth is not great, but it is improving. But beyond that, we would need a substantial rally in the rand to really warrant a further cut to 7.25.
And we haven't seen that. We're taking a look at the rand just right there. We'll have to leave it there, though. Danelee Masia, great to get you on. Thank you so much for joining us. She is the chief South Africa and Sub-Saharan Africa economist at Deutsche Bank.
And coming up, the largest international hotel operator in China, IHG Hotels and Resorts, celebrates a significant milestone in 2025. We'll speak exclusively to the CEO, Elie Maalouf, on the group's 50th anniversary of entering the market. This is Bloomberg.
Welcome back to Horizons, Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. Let's turn to China, where the economic malaise has spurred various government measures to boost growth. That includes the tourism sector, where Beijing is trying to drive spending through the use of vouchers, as well as expanding its visa-free policy. This should spell good news for those in the industry, including our next guest, a global hotelier who's in Shanghai, with our chief North Asia correspondent, Stephen Engel. Stephen?
Yeah, that's right. We're here on the banks of the Huangpu River in, of course, the capital, the financial capital of China, Shanghai, with the CEO of IHG Hotels and Resorts. That is Elie Maalouf, excuse me. Thanks so much for joining us here and having us in your beautiful property.
Great to be here with you.
So the 50th anniversary of entering the greater China market, a momentous occasion, and you are really seeing the China market as a global growth engine, even though this economy is sort of sputtering right now. How do you justify essentially doubling down on this market at a time in a deflationary market that whittles down your pricing power?
Sure. Well, first of all, it is a great moment for us, reaching 50 years, and 50 years of growth. We celebrated our 800th open hotel yesterday. We've got over 500 under development. And, looking at where we were at the third quarter, which we haven't announced the fourth quarter yet, we were headed towards a record year of hotel signings and openings in China. So that growth continues. And, being here 50 years, we've seen highs and lows, but we've made higher highs and higher lows. Travel continues to expand. The middle class continues to expand. People love to travel for profit and for pleasure across the country. And that continues. So, look, we know that there are some sectors of the economy that are not doing as well as in many economies. Like, not every sector is always doing well. China's a $20 trillion economy. So in a $20 trillion highly diversified economy, you're going to find some sectors that aren't doing well. And in China today, we know residential real estate isn't doing well. But experiences are doing well, and travel is growing.
Yeah, that's right. I mean, obviously, the barometer of industry health is RevPAR, revenue per available room. We've seen RevPAR for your group in previous reports in the third quarter and the half yearly pretty much do well, or at least up everywhere except Greater China. Yes. Down 10% RevPAR in the third quarter. How are you going to boost that pricing power?
Well, what we've seen throughout 2024, through 3 quarters of 2024, was really the same trading level of 2019. Now, in 2023, there was a boost of travel domestically when the COVID restrictions were suddenly lifted in January 2023, and you had a boost of domestic travel, and that pushed up travel and pushed up rates. And so then things settled down in 2024, but really we're still level with 2019, which is not a bad place, and barely over a year of recovery. And what our view is that things were bottoming out towards the third quarter, and things were starting to look better in the industry in the fourth quarter. The volume of travel has expanded. The rates were under some pressure due to some consumer confidence issues, of course, but the volume's expanding. And as we go into 2025, we're very optimistic. The government just announced that they're expecting 9 billion trips to be taken during Chinese New Year that starts next weekend. 9 billion trips out of a population of 1.3 billion. That's many different segments. That's going to be a record. So the other thing that we saw in 2024 was expanded travel outside of China to nearby Asian markets, Japan, Singapore, Thailand, Vietnam, South Korea. So with the visa-free restrictions that were lifted, You had more people coming in from those countries into China, more people going from China to those countries. That's fine with us.
Well, how much of that is tied to the outbound Chinese traveler? Because you saw RevPAR for Europe, Middle East, Africa, and Asia, which includes Southeast Asia, grow 4.9% in the third quarter.
Yeah, and actually, when you go to the nearer markets around China, whether it's Japan, South Korea, Singapore, Malaysia, even Cambodia, we saw double-digit RevPAR growths in those markets, in what we call our Asia-Pacific ex-China market, double-digit. Quite a bit of that was tied to China outbound, and not only we, but others in the industry have acknowledged it, which we're fine with that. You know, that movement of people across domestically in China and then leaving China is good for the industry in total. So we're optimistic about that.
How does Middle East look like right now? I know Hong Kong and China have greater ties with parts of the Middle East.
Sure.
What are you seeing there?
Look, I was just in the Middle East in November. I was in Abu Dhabi. I was in United Arab Emirates. I was in Qatar. I was in Saudi Arabia. Surely our Middle Eastern business is benefiting from Chinese inbound, but you also have to have some Middle Eastern inbound here into China. I was speaking to some of our owners yesterday evening. We had a reception of 100 of our closest owners here at the Regent in Shanghai, and many of them are seeing, you know, inbound from the Middle East. So the ties are growing. You're seeing more international inbound to China. Not as much from the U.S. anymore right now. Hopefully that will grow in the future, but you're seeing a lot from South Korea. You're seeing Japan. You're seeing you know, Middle East coming in. You're seeing more Europeans coming in. So the international is growing back into China. But China is the second or third largest outbound market in the world, and the Middle East is one of those destinations.
For international travel, what is the dampening effect of the various geopolitical shocks that are ongoing, whether it's the Russia-Ukraine war, but also there was good news overnight with the ceasefire being announced between Hamas and Israel. That obviously helps, at least for now, at least the next 6 months. But again, with Trump also coming back into the White House, there's geopolitical concerns about tariffs. How does all this weigh on potentially global travel?
Look, there are clearly geopolitical concerns. There's unfortunately some conflicts going on in the world, and we're pleased to hear that some of them may be reaching some level of solution. However, it's also a reality that last year, global tourism hit a record. The World Travel and Tourism Association projected $11 trillion worth of travel around the world last year. It hit a record. So travel may diminish in some parts of the world, but it grows in other parts of the world. And, you know, we benefit from that. We're a global company. We're in 100 countries. We've been in this business over 80 years. We're broadly distributed. We have experience with conflict, with geopolitical tensions, but we know that some of them pass over time, and they're not really everywhere. They're just in some places. Despite that, travel continues to grow. That's really the most surprising thing, is travel is almost irrepressible.
I want to come back to this market briefly because you're just saying you have more than 500 properties in the pipeline.
Yeah.
You're not owner and operator of these buildings. You do either franchise, I believe 50% are franchise model, and others are management, essentially. Exactly. So has that obviously helped you, at least shielded you from this extreme, painful downturn in the property market here? And what have you seen as far as used or vacant office spaces potentially being turned into hotels?
Look, the downturn in real estate is mostly concentrated in the residential real estate. The hotel market's still doing pretty well. Last night, as I said, we had a large event with 100 of our most important owners here in China. And I actually went around and met with every single one of them throughout the evening. And to a person, they were all optimistic. They all were looking forward to invest more. They all were looking to do more hotels with IHG. And there was just no sense of negativity. So, and the reason is that the hotel industry, we've maintained our occupancy pretty much plus or minus a point or two through 3 quarters of 2024. It was rate that came under a little bit of pressure, but volume grew, travel grew, and occupancy was relatively stable. And of course, we added, you know, another 100 hotels in 2024, and we announced our 800th hotel. So, in the real estate segment of hotels, it's still very resilient. And yeah, there might be some conversion opportunities from office to hotels, but that's really not going to be where most of growth is going to come from. It may be more actually from residential to hotels, because those buildings are more purpose-built with individual units.
Can you build on these numbers? Nearly 35% globally of your pipeline rooms are here in China, I believe. 30% of new signings are also in Greater China.
Yes.
I mean, that's about a third of your global business in this part of the world.
We're very evenly distributed. Our Americas business, our EMEA business, and then our China business are about a third of our future pipeline. And that means that we're strategically and properly distributed around the three most important markets of the world: North America, Europe and the rest of Asia, and then China. And China has always been a major source of growth for us. That's why we've been 50 years here, and that's why we're excited about the next 50.
Elie Maalouf, thanks so much. We could spend another half hour talking. 8 minutes is too short. Please have us back to your lovely property.
Look forward to being back with you.
All right, thanks so much. All right, Jennifer, we're going to send it back to you from Shanghai.
You know, 8 minutes was enough to convince me I'm ready to travel again. Stephen, great interview. Thanks so much to Stephen Engel, our Chief North Asia Correspondent with Elie Maalouf, IHG Hotels and Resorts CEO, excuse me. Coming up, the world's largest chip maker, TSMC, beats profit estimates, reporting net income of 374.7 billion Taiwan dollars. We'll discuss more on the company's fourth quarter results next. This is Bloomberg.
TSMC is keeping up its impressive streak of outperforming average estimates with net income of 374.7 billion Taiwan dollars, beating the 369.84 billion that was expected. It comes as the U.S. plans to introduce new regulations to prevent advanced chips from being sold to China, targeting chip producers like TSMC, Samsung, and Intel. Bloomberg tech reporter Annabelle Jewellers joins us now. The numbers just dropping about 20 minutes ago, piecing together all of the details, but top line beat and, of course, a beat as well on the margins. So what is driving the strength for the company?
Well, it's undoubtedly just a huge amount of spending that we're seeing on AI hardware. And if anyone's been concerned whether that would be persisting into 2025, this is sort of an early indication. Of course, we'll get more in the earnings call as well and the expectations, which we can dig into in a moment. But yeah, you just mentioned that headline number there. We did see net income coming in at around $11.4 billion, so beating estimates. And as you said, the margin doing better than expected as well. So up 59%. The estimate had been for 58.5%. What's interesting as well, when you think about the margins and how they're managing to increase those, it also just talks to how much money TSMC is making from its higher value, more advanced technology. So when you drill down, you can see that, the revenue that came from out of the total wafer revenue, but out of the 7-nanometer chips and above, that made up nearly 75% of that. So again, they're just continuing to make more money from these more advanced chips. And again, that plays out into the gross margin theme because it did better than expected. So TSMC really very strong, of course, as an AI player.
And just quickly, what are we looking for on the earnings call?
Earnings call is going to be really on the guidance that we get, not just for the first quarter, but also for the first full year. What else they're also doing in terms of demand around smartphone, computing areas. On the business side or supply side, CapEx plans, overseas expansion. Really want to get a sense of, is this upside going to be extending? And of course, the main one as well is geopolitical issues, because we just saw sales to China continuing to decline. So now they're around 9% rather, 75% going into North America. So how is this company going to be grappling with those restrictions that you mentioned? The US looking to further curb the flows of advanced technology to China.
Yeah. Bloomberg tech reporter Annabelle Jewellers, thank you for bringing us the latest on TSMC. Well, we're going to leave you with a picture of equity futures after yesterday's very strong day. Big day, of course, here in the region. And this was it for our show, Horizons Middle East and Africa.